Welcome, and thank you for listening in on today's webinar. Today, we will be focusing on a labor market in flux, including job losses, changes in income, and what it means for the economic outlook for fall. Leading today's economic update is Danielle Marceau, Senior Economist here at Previdere. Danielle, we look forward to your insights, and thank you for joining us today.
Thanks. So today we have a couple topics to talk about. The first thing is we really need to just step back and take a look at where we are in the midst of this health pandemic. At the end of the day, we are in a macroeconomic recession, but it is driven by this unforecastable health pandemic. And the shape of the economic recovery and the depths of the economic recession really are going to be dependent upon how this health crisis looks from a global perspective. So we'll take a look at where we are with respects to COVID-19 and the health pandemic. From there, we're going to shift and take a look at the labor market and some of the unique statistics from the August jobs report that we saw, as many of those were better than expected. And then lastly, I want to make sure that we also focus on what that all means to consumers' income, because at the end of the day, consumers' income and their ability to spend is going to be one of the key components of dragging the U.S. economy out of the current recession. So despite some volatility in the number of new daily cases of COVID-19, worldwide, it looks like we've kind of flatlined. Initially, earlier in August, it looked like we may be on the downward trek of worldwide cases, but now with a few more weeks of data, it looks like we really just plateaued. We aren't starting to see a pronounced and definitive decline in new cases worldwide. This is important because while the U.S. economy really is largely reliant on domestic spending, with 2/3 of our GDP coming from U.S. consumer spending, we still really are dependent upon a thriving global economy in order to return to a period of robust economic growth. So the longer this health crisis lingers in a worldwide global perspective, the longer that it's going to have an impact on the U.S. economy as well. Now, shifting specifically to the United States, if you look at the blue line here on the top chart, you can see that we are definitively seeing that downward trend continue when you're looking at new cases of COVID-19. That's great, but that decline really is at a very slow pace. It's really a lot slower than we saw the rise going into it. And the longer it takes for the pandemic to subside, the deeper this recession is likely to be, and the more businesses are likely to struggle under the weight of the decreased demand and government intervention and regulation as far as keeping COVID-19 at bay. So we are in the downward trend here. That's good news, but the slow pace of decline really has prolonged that timeline for normalcy, or when we're likely to see the U.S. economy return to normal. So when you're taking a look at this, what this tells us is that the economy is still continuing to face challenges through the remainder of this year and into 2021. Some of the big challenges that we're going to talk about today are the temporary layoffs that first started at the beginning of this pandemic, and how many of those are turning into permanent job losses. We'll also talk a little bit about workers who are remaining hesitant to actually return to the workforce and how that may be impacting some of the unemployment numbers. And then what all of this means for earnings and income. Jobs are important, but really jobs are that proxy for consumers' income and money in their pocket to spend, because the U.S. economy and growth for the U.S. economy really is dependent upon consumers' ability to spend. So we'll talk about that in a little bit more detail. But overall, we do see a lot of downside economic risks still to the U.S. economy throughout the remainder of this year. So let's talk a little bit about this labor market. The first chart you see here on the left, this is showing the lighter blue line, which is temporary layoffs. This is just the total number of people that were temporarily laid off during this pandemic. As you can see, that number spiked early this year, and it is continuing to decline as people are returning to work. As this pandemic was first taking shape and the recession was first taking hold, that really was the talk that this was temporary. This was going to be temporary. Once the health crisis subsided, all of these people would be returning to their jobs, and the economy could potentially bounce back to exactly where it was pre-pandemic. Well, as we're 6 months into this pandemic, we're seeing that that's not how it is shaping up. And a lot of these temporary layoffs are converting into permanent layoffs. So that darker blue line there, the bottom on the left-hand chart, you can see we are starting to see a pretty big increase in the number of permanent layoffs. This is a big structural shift in the number of people who don't have jobs right now. It actually accelerated in August. So in July, we did see, if you come in here very closely, you can see it stalled out a little bit. That permanent layoffs stalled out in July, but with the August jobs report, that accelerated a little bit further. This could be, some of the reason could be the expiration of some of the Paycheck Protection Program funds, some of those funds running out. Businesses that may have been able to keep people employed due to the support of that, maybe having to now lay them off, or perhaps businesses are shutting their doors. And we'll talk a little bit about that on the next slide. We're going to have to pay very close attention to this. We expect to see that permanent layoffs continue to increase over the next couple job reports. There's been a lot of headlines recently where a lot of major corporations, they are continuing layoffs, and they're talking about many temporary furloughs turning into those permanent job losses. They're expecting that to happen going forward. Some particular industries, such as the airline industry, they took some pretty large and substantial government funding early in this pandemic as they were hit very, very hard. But along with that funding came some stipulations around keeping people employed or not permanently laid off through the end of September. But there's already been a lot of talk amongst the airline industry of a lot of major layoffs happening coming in October. So that's going to continue to contribute to that permanent layoffs line. You're also seeing a lot of other big corporations that are talking about some big job cuts coming, companies such as Ford, Coca-Cola, Salesforce, Boeing, a lot of different industries talking about the future potential of major layoffs, trying to cut their costs as this economic recession persists. So we're starting to see that those initial temporary layoffs, they're starting to convert to permanent. It's not just going to be a snapback to where we were pre-pandemic, as was the hope early on. So this is something key that we're going to need to be paying attention to. Now, I just talked about this and I said, we're starting to see more people that are permanently without jobs. But if you actually looked at the headline unemployment number in the August release, it was a little bit better than expected. The headline unemployment rate was only at 8.4%. It's better than anticipated from the consensus of many economists. But one of the things that is likely contributing to that lower unemployment number, and why we may be seeing that number underestimate the actual number of people unemployed, is the chart that you're looking at here on the right. This is showing what is called marginally attached workers. So what is a marginally attached worker? This is somebody who is not in the labor force. That means they're not actually counted in the unemployed number. They're not actively in the labor force. They want a job, and they are of working age and able to work, but they did not search for a job within the last 4 weeks. So what this is saying is there's a lot of people out there that are not working, but they're not actively searching for a job at this exact moment in time or for the last 4 weeks through August for the August report, and therefore they're not counted in that unemployment number. So you can see that this has not returned to pre-pandemic levels. There may be quite a few reasons why people are not actively searching. Perhaps it has to do with childcare, having people to take care of their children, or homeschooling. Somebody needs to be at home to homeschool their children. It could be fear of the actual health pandemic. They may be high risk and may not want to return to work for fear of contracting the virus. But either way, this is showing us people who are not employed and do not have an income, and they are not counted in the headline unemployment number. So this is likely resulting in a little bit of an underestimate when you're thinking about labor as a proxy for dollars in the pocket of the American consumer to spend. So this is also concerning. The higher this is, the more likely we are seeing understated unemployment numbers. So I briefly mentioned before, one of the reasons that some of these temporary layoffs may be converting to permanent layoffs is because we're starting to see a lot of businesses close up permanently versus temporarily. So if you actually look at business closures in the United States, starting in pre-pandemic or midst of the pandemic here, what we're seeing through July is that the number of business closures that are permanent, they do not intend to ever reopen, is now larger than temporary. So at first, you can see this was relatively small. People expected that the closure was going to be temporary and that they were going to open up once again. But now we're seeing that shift, that dynamic shift, and there's a larger percentage of businesses that are permanently closed than temporarily closed. You can see some interesting results from some surveys and polls. 77% of employees who actually lost their job due to the pandemic, they expect to get it back. But 42% of job losses are likely to be permanent. This is from a working paper from the University of Chicago. What's interesting is that means about 1 out of every 5 people who lost their job will be surprised to not get it back. So that's going to be 1 of every 5 people are going to be surprised that they're going to jump from that temporarily unemployed to that permanently unemployed line on our previous chart. So I'm talking about, the fact that the unemployment number unemployment rate, while it is higher than pre-pandemic, it is relatively high. It's better than anticipated. I'm talking about marginally attached workers. There's a lot of people out there who are just not searching for a job, but they are not employed. We're talking about the shift from temporary to permanent unemployment and how that accelerated in August. So the question really becomes, why are so many of these economic numbers, such as personal consumption expenditures and retail sales, actually seeing more optimistic results? So if people are not employed and don't have a job, and even if they're not looking for a job, why are some of the more macroeconomic data sets around consumer spending so optimistic when you're looking at recent figures? If you've seen any recent retail sales headlines, you've seen that seasonally adjusted retail sales actually returned to pre-pandemic levels when you were looking at the July numbers. So the question becomes, why did that happen? And the reason is because we're seeing a really interesting dynamic happen when it comes to how much money the American consumer has in their pocket. The chart that you're looking at has the orange line showing us the year-over-year percent change or growth on a monthly basis for total personal income in the United States. So this is the total dollars that the American consumers have in their pocket to spend. The blue line is the year-over-year percentage change on a monthly basis, so growth versus the prior year, of just compensation. So this is income that consumers have in their pocket from labor, from wages, from working, from having a job. And historically, you can see that total personal income flows very closely with compensation or earning or wages. This is really the first time that we are actually seeing such a major divergence. So consumers actually have way more money in their pocket throughout this pandemic than they have ever had historically. Actually, even through August, they saw 7% more dollars in their pocket to spend versus August of last year. So despite the dynamics of the labor market and earnings from actual wages being down 1%, consumers have had more money to spend than they have ever had before. And many of them were spending it. We've talked at some of our previous updates talking a little bit about the unique spending dynamics that we're seeing going on. But at the end of the day, people were spending a good chunk of that money. So the question becomes, why? Why are we seeing this divergence? And this is really due to the government intervention that we've been seeing. So the stimulus and the extended unemployment benefits, as you can see from this chart, has more than made up for lost wages throughout the summer. So despite what has been going on in the labor market, consumers have had that money to spend because they've been getting it in unconventional ways. But what this means is that when that stimulus and the extended unemployment benefits run out, which really has already started to happen when you're thinking about the fact that we are in September now, we're going to really start to see an income cliff where we're no longer going to have that counteracting the negativity from the labor market. So when is that actually going to take shape? When are we going to feel that pain? This chart is actually showing you some future estimates of when we do expect to see that happen. So the line here, the dotted and the solid line, this is disposable personal income. It's looking year-over-year growth, so change from the same month of the prior year. As you can see, it is positive. It is above this zero line. This is what we were just looking at. When you're looking at total income in consumers' pockets, it has been higher than the prior year. But that's really been bolstered. If you look at the bars, it's telling us where that's coming from. Has it been coming from earnings, unemployment benefits, cash payments? This is that one-time stimulus, $1,200 per person check that was sent out. And between the extended unemployment benefits and the cash payment, that has absolutely offset declines in the earnings from labor. As we look at that going forward, that is going to be a very shifting and changing dynamic. The fourth quarter of this year, we're actually going to start to see that earnings drop, or the disposable personal income, it's going to drop below where it was last year. It's going to become a major headwind without an additional round of stimulus. And as we start to see that taper off, that drop in labor compensation, because of the fact that we're seeing more and more people unemployed, permanently unemployed, not making as much money on unemployment as they were when they were employed, we're going to see a real decline in consumer income. That's really going to hit us around the fourth quarter of this year. And really, that's critical when thinking about the U.S. economy, because what does this mean when it comes to consumers' ability to spend? This is going to be a major headwind that's likely to prolong this economic recession, and we'll start to see the depths of the decline in consumer spending start to happen as we enter into 2021. So we're not likely to see as big of a pullback as we saw earlier this year, but we don't expect a return directly to pre-COVID, pre-crisis levels when it comes to the amount that the U.S. consumer is spending. So this is one of the key things that we are going to be keeping our eyes on here. As all of this stimulus subsides, tapers away, we're really going to be focusing on the labor market and that structural shift to the permanent layoffs that we're seeing and what that ultimately is doing to consumer income, because that's very important to be monitoring when it comes to assessing the health of the U.S. economy.
Thank you, Danielle, for those great insights, which are so important as companies navigate the intricacies of this recession. That includes today's economic update. If you have any questions for Danielle, please contact me at the contact information on the screen. And as always, stay tuned for follow-up presentations. Thank you and have a nice day.